Mark, where do you see value in the emerging markets, and actually what could disrupt them? Is it trade tensions or just a too aggressive monetary policy from the Fed?
There's no question that, trade tensions, if they turn out to be that way, which I don't think will happen, will be very bad for emerging markets generally. Well, the world in general, but emerging markets. The interesting thing is that I recently came back from Washington. We were talking with the IVC about export-led growth. Well, that's over for a lot of emerging countries. The exports are not a big deal for many of these countries. It's now internal growth, and that's particularly true in China. So the end of trade exports for some countries is not going to be a big deal. And I think they can stimulate the economy by internal growth. So if you ask me which countries are you interested in, I'm interested in those countries where internal growth is fast. China, India, in some parts of Africa, in some parts of Latin America. If you look at Brazil, for example, big consuming country, and they can do a lot internally to produce goods that they actually consume.
Right, but how would that, I mean, if we're seeing a belligerent U.S. when it comes to, trade surpluses and all of that, could it touch other parts of the emerging markets apart from China?
Oh, definitely, no question. Interesting way it's going to touch these other countries is that if China, let's say, is shut off from exports to the U.S., they're going to have to turn towards other parts of emerging countries, particularly Southeast Asia. In order to do that, they've got to stimulate exports from those countries. So there's going to have to be a complete, and it's already happening, by the way. If you look at trade in Southeast Asia, the major trade partner is China already.